Welcome to today's session. I am Dr. Neha Seth, working as an Associate Professor at School of Management Studies, Indira Gandhi National Open University. And today I am going to discuss with you on this topic called Introduction to Financial System. This topic belongs to a course called Equity Markets, which is widely taught across the nation under different programs, MBA, MCOM, and many such programs. So today our focus will be on Introduction of Financial System, wherein we will cover the basic introduction of financial system. We will try to understand that what do we mean by this term called financial system, what are the functions of financial system, how Indian financial system evolved, and what are the components of financial system. We will touch these components of financial system today, but in going further in future lectures, we'll deep dive into these components of financial system as well. So starting with the introduction of financial system. So what do we understand by this term called financial system? I often try to explain this to my student with the example of a spider web. Just like a spider web is connected, different points of spider webs are connected to each other, and these points are developing this spider web in such a way that it is giving strength to that web. Similarly, different components of financial system are also connected to each other to form a web type of structure, which is helping each other for developing the strength of the financial system. So these components are mutually coming together, giving strength to our financial system, that is Indian financial system. And this is how our system works. Okay, just to explain this further, just to discuss this further, I want to give you one example. Okay, for example, let us say there is person 1 and there is person 2. Now this person 1 is a businessman, okay, and he needs some funds. Okay, the funds that a businessman needs for his business is called capital for him. Okay, if you want to start business, he needs capital. Okay, but on the other hand, there is a person B who is working as an employee, maybe in public sector. Now he is getting salary every month and he is consuming from his salary. After his regular consumption, he left out with some money that he wants to put into saving. He wants to put this money into saving in such a way that he should earn something out of this spare amount. That means he wants to invest this money. Now person A needs some platform from where he can get this capital to start the business, and person B also needs some platform or some space where he can invest his spare money so that he can also earn something out of it. And this platform to both of them is provided by our financial system. So we can say that our financial system is a bridge, is a link between the lenders and the borrowers. Okay. Now what will happen? This person B, who is an employee, he has this spare money. He may go to the bank. He can deposit this money into bank and he may earn interest over his money. So this is how he can put his money to some efficient use and he can earn interest from that money. And this person A, who is a businessman, he can also go to the bank and he can ask for loan. He can request for loan, and in lieu of some rate of interest, he can get loan to start his business. Now he can also start his business once the loan is granted to him. Now once he'll get this loan, now he has capital to start the business. What he will do? He will purchase land. He may build a factory over that, maybe he will purchase a building, he will purchase some machinery, he will hire resources, he will call labor to work for him, and in lieu of this work, he will pay salary to the labor who is working for him. And once this labor will get the salary, he will consume and he will also look for some options where he can go and invest his spare money and he can earn out of it. He will again go to some bank. He will put his money and some other businessman can take this money in the form of capital from the bank. So this is how this vicious circle works. This is how our economic circle works. And the functioning of this economic circle is possible because of our financial system. This is what we call our financial system is. So just to put it in formal words, I would like to say that the financial system is set of institutions, markets or instruments. These are components of our financial system. Institutions, markets or instruments that promote savings by channelizing them to most efficient use. The financial system of an economy provides a way to exchange funds between lenders and borrowers. So basically it works as a bridge, it works as a link, okay, so that a lender and a borrower can come to the same platform, and this platform can satisfy the requirement of both of these set of people. And the efficient allocation of economic resources is achieved with the help of financial system. And Indian financial system is believed to be one of the strongest financial system in the world now. To reiterate this in another way, so a financial system can be said as a set of these components. These components are institutions, markets, instruments and services. So it may be financial institutions, financial markets, financial instruments or financial services, and these are clubbed together. A set is made for these components to promote savings, right? And these savings provides, and once all these components are clubbed together, it will provide a platform for exchange of fund. And this platform is provided for lenders and borrowers. And why it is done? It is done to achieve the efficient allocation of our economic resources. So this is the way how we can utilize our economic resources in a best possible way. Okay, we can get best efficiency out of our economic resources that are available to us, right? There are famous authors, famous writers, academicians who have defined financial system in their own way. So one of such famous author is Van Horn, who has contributed in the field of finance. He is a renowned person in the field of finance, and he is widely known for his book on financial management. He quoted that the financial system allocates savings efficiently in an economy to ultimate users, either for investment in real assets or for the purpose of consumption. So this is the definition of financial system in the words of Van Horn. Similarly, one of very famous Indian author who has again contributed in the field of finance, Professor Prasanna Chandra, he also defined financial system in his own words, and he said the financial system consists of a variety of institutions, markets and instruments related in a systematic manner and provides the principal means by which savings are transformed into investments. Okay, so this is how we can formalize the definition of financial system. So these are the definitions which was given by very famous authors in the field of finance itself. Going further, we would like to discuss that what are the functions of financial system? What are different functions which are served by financial system? So majorly financial systems helps us in these manner. The first and foremost function that financial systems serve for us is saving function. So in the definition itself, I mentioned that it is a platform where borrowers and lenders are coming together. So this financial system helps us in saving. So anybody who has excess funds can go to our financial system, can go to our financial markets, okay, and our financial instruments. They can put their savings and earn out of these invested funds. So this kind of saving function, when you have excess resources with you, so how we can put these excess resources to best of its use, this can be done with the help of financial system, and this is how our financial system helps us in promoting saving, in increasing savings, and how we can earn best out of our excess amount. Then another function that a financial system serves is liquidity functions. Now we have invested our excess amount in different kind of financial instruments, right? Now if suddenly a need of cash arises and I want some money for the purpose of consumption, I can immediately go to these financial markets. I can sell out my financial assets in these markets, and these assets can be easily convertible into cash or cash equivalent that I can use for the purpose of consumption. So this is how the components of financial systems helps us in providing immediate liquidity whenever we need it. The third important function that financial systems serve is payment system. So you remember earlier when there was no currency, no source of exchange existed, at that time we used barter system for the purpose of exchange. Right. After barter system, the currency concept was introduced. Then the people started using currency for the purpose of exchange. Sooner and later, when financial institutions developed, then banks existed. Then the concept of checks arise when we use checks for the purpose of exchange. And then we are now using this plastic money, that is like our debit cards and credit cards. Okay, these were very popular among people for the purpose of exchange. And after that, we have now moved to e-wallets, UPI. So these kind of transactions are now very popular, especially in our nation. Okay, so this is how we have transformed from barter systems to this no cash system, where we don't need to carry cash, we don't need to use checks for the purpose of exchange of funds, for the purpose of buying or selling anything. So this payment function, the mode of payment, is provided by financial system. This transformation is possible in our country because of the financial system that we are having now, right? Then apart from this, the financial system also helps us as risk function. That means it is helping us in covering the risk, be it risk of life, risk of health, maybe any kind of physical asset or fictitious asset. Any kind of asset can be covered with the help of buying insurance. So that means insurance is something that is helping us. Again, this is also one of the component of financial system that is helping us in risk management as well. So this is the fourth most important function of our financial system, that is risk management function, or I can say risk function. Then apart from these four major functions, there may be another small functions that a financial system is doing for us, like information function. That means if we want to have prices of any kind of financial asset, if we want to have any kind of information related to financial markets or financial instruments, so that information function is also served by our financial system. Apart from that, a reformative function, it is also served by our financial system. That means the progression that we are doing from time to time, when the new concepts, new technology, new financial instruments that are coming into the market, these are being introduced by our financial system only. So in that sense, we can say that our financial system is also giving us or helping us with its transformative system. So these four are the major functions. Then additional to that, reformative and information function is also served by our financial system. Now, after this, we will discuss the evolution of Indian financial system. So Indian financial system is majorly classified into three phases, that is pre-independence phase, post-independence phase and post-1991 phase. Why specifically 1991 phase is mentioned here? Because this is the time where LPG policy, liberalization, privatization, globalization policy was introduced at this time. And after this, the development of our nation took another level. Okay, so our financial system also developed into these three phases. So let us discuss these phases one by one. So first, we will discuss this pre-independence phase, which existed up to 1951. So under this stage, the structure of financial system during pre-independence era was that of traditional economy. So by this time, we were working under traditional economy, and the main feature of financial system of pre-1951 were those of closed economy. So by this time, our economy was absolutely a closed economy. When I say this closed economy, then this economy has these features, like we don't have properly organized security markets. That means at that time, we were working in semi-organized security markets. At that time, closed circle industrial entrepreneurship was existing. There were restrictions to access to foreign savings as well. There was absence of financial institutions in long-term industrial financing at that time. And after that, once this pre-independence phase was over, after 1951, we entered into post-independence phase that existed up to 1991 prior to introduction of LPG or industrial policy. During this phase, there has been a significant growth in Indian financial system in terms of quantitative indicators like GDP, national income. So these were numbers which have shown the growth of Indian financial sector. But not just this. At the same time, the diversification and innovation that was happening in our nation was tremendous. Okay, then this period was the progressive transfer of its important constituents from private ownership to public ownership. And an overview of the development of Indian financial system in post-independence period up to 1990s are categorized as follows. So it is also divided into different phases. Amongst this, the first one was nationalization of banking and insurance sector. So in 1951, the post-1951 phase was a landmark era in the history of Indian financial system with the nationalization of RBI in 1949 and SBI in 1955. Okay, and not just this, not just banks, insurance sectors were also nationalized at that time. So in 1969, 14 major commercial banks were brought under direct control of Government of India. And during that time also, the nationalization of LIC, that is Life Insurance Corporation, that happened in 1956. And of course, GIC was also nationalized in year 1972. These were another historical measures that were considered by Government of India during nationalization of our banking and insurance sector. Another development was happened in terms of our development banks or our development institutions. So the government created a wide range of new institutions in public sectors. So there were new institutions which were developed by our government at that time. The institutions were created to cater financial needs of industries and between them covered the whole range of industry. The public sector occupied commanding position in the industrial financial system in India at that time. So public sector was on boom at that time. So everything falls, more or less everything falls under the control of government, and government was continuously working for the development of Indian financial system at that time. And when our Indian financial system was developing, people were coming up for the purpose of investment. Okay, so now when people are putting their hard-earned money into different kind of financial assets, they seek some kind of protection as well. And as a result, concept of investor protection also introduced at that time. Now, during this period, there were gross mismanagement of the companies, corporate frauds and abuses. These kind of things were happening. As a result, there was loss of public confidence in corporates and security markets, which were coming up at that time. Now, to restore investors' faith and confidence, the government adopted drastic measures, and government introduced number of laws for the purpose of investor protection at that time. The Companies Laws 1956, the Capital Issues Act 1947, Securities Contract Act 1956, Monopolies and Restrictive Trade Practices Act 1970, Foreign Exchange Regulation Act 1973, and many more. Such acts were introduced by the government during that time to take care of our investors, to build their trust in our financial system, to invite them to come and feel secure so that they can come and invest in financial system, and our financial system, our economic cycle will work with a faster pace. So this was the situation of pre-new industrial policy, that means up to 1990. After 1990, a new industrial policy, that is new industrial policy was introduced, and after that there was a major transformation that happened in our Indian financial system. So this is the situation that we are going to discuss, was the situation of post new industrial policy in 1991. And this resulted into profound transformation in Indian financial system, and the conservative philosophy of development process shifts to free market economy. So earlier we were closed economies, but after that we became free market economies. Okay. Now again, there are major changes that happened in this post 1991 era as well. Out of these, the first one is the control, which was earlier in public hands, was transferred to private hands. That means we transformed from public control to private ownership. These are the major changes that were noticed at that time. So the major step initiated during this phase were to privatize important financial institutions. So the focus was given to financial institutions and the steps were taken to privatize these financial institutions. The conversion of Industrial Finance Corporation of India, that is IFCI, into public limited company. IDBI offering their equity to private investors were all part of privatization of financial institutions. Apart from that, the setting up of private mutual funds and banks under guidelines of RBI also came into existence after 1991. So, there is another transformation that has happened during this post 1991 era, that is transformation of institutional structure. Now it became more capital market oriented. Now we are becoming open market economy now, and we are moving toward capital market orientation as well. Now this is reflected in the changes in roles, organizational policies, term lending, commercial banks, mutual funds and so on. And after this, in August 1991, a high-level committee was appointed under chairmanship of Mr. M. Narasimhan, our former RBI governor. And the committee submitted its report in November 1991 with some suggestions. And these are few suggestions which were given by this committee. These suggestions include privatization of financial institutions, reorganization of existing financial structure, protection of our investors, most importantly, adequacy of capital structure, review of supervisory arrangement, improvement in efficiency, effectiveness and competitiveness was the requirement at that time. So these were the suggestions which was given by M. Narasimhan's committee for the purpose of transformation of our institutional structure. So this was the situation, these were the different phases based on which our financial system transformed from pre-independence to post-independence to post-1991 era. So before we end for the day, I just want to give a brief about the components of Indian financial system. So our Indian financial system comprises of 4 major components, that is financial institutions and intermediaries, which further divided as banks and NBFIs, that is non-banking financial institutions. Then we have financial institutions that may be categorized as primary financial institutions, which are directly inviting the lenders who can come and invest. Then secondary instruments, okay, just like mutual funds. And then we have instruments for risk covering, risk management as well, like derivatives. So these may be our financial instruments. Then we have financial markets that are categorized as money market and capital market. So money market is the market where the instruments are traded, financial instruments are traded for time period which is less than 1 year. So money market may also be called as call market, T-bill market, commercial paper market, because these all are money market instruments. That means these are the instruments which are traded for time period which is less than 1 year. Then we have capital markets. So capital markets are also known as long-term markets. Capital markets can further be classified as primary markets and secondary markets. So when a financial asset is introduced in the market for the first time, okay, so it is said that the market in which this financial asset is traded for the first time is primary market, and further trading of that particular asset is happening or will happen in secondary market. Okay, so this is how our capital markets are classified. Then the fourth instrument is financial services, and financial services are further classified as fee-based services and fund-based services. So today we have discussed the introduction of financial system. We talked about the functions of financial system. We have also seen the development of Indian financial system, how it evolved in 3 different phases. We just touched this Indian financial systems component that we will discuss in our future sessions. So that is all from my side for the day. Thank you. See you.